So now we get to turn towards the export market. We're going to look at what's happening within the U.S. and then what's happening abroad to kind of look at some of the different functionality. And we'll talk about the OPEC, the new OPEC agreement. What does it mean for January, February, March in the OPEC show? But there'll be some talk about it here. But again, we're going to focus more on it there, and we'll look at more products and just oil movements, as they're happening right now, and then kind of what does it mean going forward. So again, please like, share, subscribe. Again, that support is important, and sharing it is key. Getting other people to watch, helps the views and all the other fun side of the of building this product. So as we look at gasoline, gasoline was down just 28,000 barrels a day. Again, something that we were kind of considering in terms of gasoline, disti just being fairly flat, not too much up or down. We thought distillate was going to have a little bit more of a walk back. It really didn't. It kind of went back up a little bit, but again, 10,000 barrels. We had big drops in some other areas. LPG fell 559,000 barrels, but again, you can see it's still above year-over-year, 5-year average. We do have the new facility, so it's always, well, I shouldn't say always. It's going to be easier for it to be an outpace year-over-year and 5-year until we start to get this facility kind of factored into those year-over-year numbers. But again, that's something where when we look at the export market, LPG in general will continue to move, especially as we have shortages in power. As we look in Asia, when we'll in the OPEC show, we'll talk about LNG, and we're actually building a product that's going to focus purely on NGLs and LNG, and we're going to have models and all that fun stuff, just because it's something that we think it's going to be a bullish backdrop over the next, let's call it the next decade. And but again, the shortages of natural gas, the shortages for power is pushing people to purchase generators and other types of means, with some of them being powered by propane, which is going to be, again, that bullishness. Now, when we look at oil exports, so oil exports were actually rose 7,000 barrels, and so we actually maintained that 3.63. As we were saying last week, and we thought that it might move down, but again, it's just there was such a move to get product out of the U.S., get it out of tanks, reduce total holdings within PADD 3, because that's where obviously they count barrels. But we continue to see purchases and pretty stable purchases going into South Korea and China. Now, Europe has been another one that has seen some pretty steady buying, but that's going to kind of cool off. And now as we go into a bit more of a normalized market in general, that's going to start to kind of get into this new level. Where, what is the new level? And that's where we're starting to think that 2.8, is where we think that we're going to be, 2.6, 2.8 as we head into the end of this week into next week. The Houston Ship Channel did shut down for about 6 hours due to fog and weather. But again, that's something that should be fairly transitory and shouldn't really impact as much, as we go into next week. But U.S. exports are going to be one to watch, especially with Saudi cutting 1 million barrels for February and March, and at the same time also increasing their OSPs, which is the official selling price, which we'll talk about in a little bit. But now when we look at gasoline exports here, you can see that we're starting off at a strong number, where as we go back to the last 9 years, we're still elevated. That's something that's going to continue. We'll continue to outpace the seasonal average, just because there is that demand for our product overall, and especially as we look in Latin America. The question is going to be, will there be additional pressure coming from Europe if PADD 1 or the East Coast really can't take additional product, because we're at the highest levels we've been at since 92 in terms of gasoline and storage? Will we start to defer, or at least buy and then resell into LATAM and try to move product? That's going to be something to watch. But over the next couple weeks, we're still going to see elevated gasoline exports going to the market, as there remains fairly robust demand, especially in LATAM. The bigger issue, which is what we've talked about, is going to be in disti exports. So we still outpaced the 9-year average. We were thinking it was going to be a little bit below that. You can see that it kind of starts out elevated, then drops when we look at the average overall, and that's something that we think that we're going to see something similar in general. But the question is going to be, where do we see this over time? And as you know, when we look at Europe, and Europe is actually exporting more than before, and you know, the exports are still coming into the U.S. because distillate imports outpaced jet fuel and gasoline combined, which is very rare in terms of, you know, or I should say on the rarer side, just given where spreads are and what normally makes sense. And that's why we continue to see pressure in our export market, which again is going to show up, and it's going to move us closer to kind of that normal average. Now, when we look at exports, you know, exports closed out the year strong, obviously not 2019 strong, closed out 2020 strong, and we're kicking off the year at highs, and we can say all-time highs, just given, you know, I should say seasonally adjusted all-time highs, because you can see there are parts in 2020 that were higher, but seasonally adjusted, this is elevated. It's going to continue to be elevated. It's just something where it's going to fall closer into kind of what this normalized is, which is really going to be what we think is going to be between 2020 and 2019, where we'll be within that kind of 2.8, you know, 2.9 level, you know, probably dip a little bit lower, but it'll be in buckets, because there's those timing delays that continue to be the inherent problem in terms of getting stuff out. And we've seen you know, several weeks of continuous aggressive exports, which is going to have to adjust to allow some imports. And again, that timing, because right now it was all export, no import, because they were trying to reduce the amount of barrels in PADD 3, lots of exports, little imports. That's going to start to reverse a bit. And that'll start to normalize not only crude and storage, but also some of these export numbers over the next couple weeks. Propane closed out the year, all-time highs, not surprising. And we're starting off the year at seasonally adjusted all-time highs, which is why we keep talking about the additional facility is going to continue to keep that. And then the demand from just not having enough electricity, not having enough stuff just in the global market, you know, not enough coming from LPG coming from the Middle East abroad. That's going to keep our exports flowing, and really EPD, PSX, they're going to continue to see a lot of demand within this realm. Now, when we look at crude oil and transit, so right now a total of 10 VLCCs carrying about, you know, they're continuing to move. We're seeing more and more oil in transit overall. We're right at the 5-year average, which is better to see in terms of kind of seeing some of this normalization. This is what we have to consider when we're starting to look at things starting to normalize on crude oil in transit. The crude oil in transit is getting back to the average, but we still aren't seeing average or normal refinery throughput, just because that we're seeing, you know, there's still issues in terms of kind of where the timing is, who's ramping, who's declining. The U.S., again, 80%, you know, we still have facilities in Europe that are either shut down or cut runs to the bare minimum. We have reductions that remain in Singapore, Korea, Japan. We do have some increases in India and China, but again, it's just a matter of, you know, that's why when we look at this, we think there's going to start to, you know, the question is going to be, will this go straight into onshore storage, or is that starting to fill up because we're just not seeing kind of those adjustments? But again, this normalization, you know, this is something that we have to watch to see, will it convert into floating storage at this point? And then when we look at, you know, crude oil on the water, we're still coming in at an elevated level, just because we still have a significant amount of crude that is sitting in storage, especially versus last year. Obviously, when we look at total of 2016, 2017, which is, you know, 2016 was actually that the top of the cloud, we still have those elevated levels. North Sea flows to Asia are expected to remain strong. North Sea is actually going to be pumping at about have a loading schedule, which will put exports at about 2.2 million barrels a day, which is obviously you know, something that we haven't seen in 3 years. So we're going to get a big spike, and that's really driven by Norway. One VLCC has already departed. 5 are expected to load. We have 2 different components. The Alexander the Great discharged various North Sea crudes at Rotterdam. And then we have one more that's loading 1 million that's going to load in Germany in January. So again, it's just the movements through the system, but we still have more and more crude on the water as we get oil in transit normalizing at the same time when we still have floating storage that's elevated, especially as we have movements, from the tank to the boat in order to try to avoid paying taxes in 2020 and saying that you're taking delivery January 1st, fun with numbers. And here's where we look at floating storage. So you can see we closed out 2020 with that spike. It was still below where we were in 2016. But here you can see that we're starting crude oil and floating storage, seasonally adjusted highs. And you can see 2017 is obviously where we had that elevation, just because 2016 was when everything started with OPEC as we had another price battle, which again put more floating storage in Middle East. But this is why when we're looking at floating storage, we have to consider what is going to happen when those oil and transit cargoes show up at the coast. Will they get pulled on shore, or will they have to remain offshore? And when we look at what's happening in the market, and this is where we can, we have this chart in the OPEC show as well, and we'll talk about it a little differently, but Norway's at about 1.7. The North Sea in total is going to be at about 2.2. Nigeria is struggling to sell right now, so that they were actually seeing a little bit of a bleed in terms of what's going to happen from January into Feb. Angola is struggling to sell. They're actually cutting prices. So right now, when we look at things in terms of, what is cutting prices? So Senegal cut its price for 3 cargoes of Angolan crude, with offers cut for 2 of the consignments for the second time this week. So we've already seen 2 reductions in spot pricing. And then when we look at Vietnam, they're looking to purchase, but Nigerian grades in general, when we look at price cuts out of Angola have cut by about 30 cents a barrel for each of the 3 cargoes. Compared with offers on January 4th. Chevron is offering 1 million barrels of Nigerian crude at a discount versus where they were. So now it's being offered at $1.30 a dated Brent versus $1.85 on December 30th. Again, just trying to move some of this crude, which is why when you think about, is Saudi cutting because it's looking at some of the physical pricing and seeing some of the physical pricing weakness? Or are they seeing this and saying, look, we don't want to compete with this. We don't want to have our crude on the water and have to have this knife fight to sell cargoes that can't clear by cutting prices. Instead, are we just going to leave it on the ground, maybe leave it in storage, and let this glut clear a bit, let pricing get a bit firmer, and then go and enter the market? Do they think that there's going to be a movement where COVID will get worse and there will be less demand? So, this is just the tip of the spear where physical prices are weakening, as we've been saying that they've been weakening since about December 12th. Then this is why when we talk about December, the middle to end of December, prices were getting worse and worse, and now they continue to weaken through the first week of January, where we normally see a little bit of an increase. So again, these are things that we have to consider when we're looking at the physical market into the end market. But when we look at crack spreads, this is just looking at Singapore. You can see that with a increase in feedstock prices, with the spike in crude, you had a big, I don't want to say a big drop, but you had a drop in overall margin. So we're starting off the year fairly weak. Obviously not 2019 weak, which is one of the things where we were very starting to get bearish the market, or more so. We started to get really bearish in July, and you kind of see we get this last spike and then big drop off. And this is going to be something to watch as we continue to see margins go negative. Now, this is just looking at Singapore, Dubai, hydrocracking is just kind of just snagging one, and let's digging in a little bit more. And here you can see that we're bumping against the lows, and the lows that were really created. This is the problem when we're considering, how active are these guys going to get? And right now we're at 83 cents. So we're at 83 cents. Are you really going to try to ramp because you think that you're going to sell? We're seeing storage remaining very elevated again, which is putting this pressure in terms of how much can we get some of this normalization. Now, when we look at Fujairah, so Fujairah closed out the year. It's at a 4-week low. It's still, as you can see, from September into November, we got these drawdowns, but then we started to see a big increase in December into January, and when we look at year over year, we're well above where we should be in terms of where January kicked off in 2020, and when we think about kind of peak COVID issues, as they reverberated through the system, we kind of got to about 30 million barrels that was in storage. Here we're sitting at about 23.4 million barrels, which is down about 0.9% from last week. Middle distillate had the biggest drop of 11%, which is the lowest since October. But again, this is kind of this level in terms of the end of October, and then we started to increase. The resid continues to be a problem where more of it gets built. Middle distillate, including jet fuel, and again, that's a little bit better in terms of what we're seeing. And the reason why light distillate you had the spike and now it's starting to draw down is we're seeing more go into Pakistan as they actually buy a decent amount of gasoline from this region. And middle distillate's going to be the one to watch because that's a fairly good drawdown. The question is the problem is we continue to see Europe not buying. So who is buying it? Well, we see this go into other places. Pad 5 in the U.S. actually bought jet fuel from India. It's the first time since 2015. And it's just as you continue to see these products try to move around, trying to find a home, as we still remain at elevated levels. Now, going a little bit deeper in terms of where worldwide, the crude floating storage versus 2019, you can see that we're starting to carry over. And we did get a big spike at the end of last week, and now that we're in January, you can see that we're not getting back to those levels as these new oil in transit start to convert back into floating storage. And the amount of crude, it did fall. It went, it fell to about 93.6 million barrels, which is down about 6.7% from the 100 million the week before. Asia was down 8.7%. Europe had that drawdown, as we talked about, some of the unloading into Germany. Europe was down 41%. Middle East was down 74%. West Africa is up 25%. North Sea down 41%. U.S. Gulf down 47%. Again, we're starting to just see those movements. It's just we're not seeing the drawdown that would make us feel more comfortable, especially as we head into the Lunar New Year and some of this normalization. When we look at super tankers, this is just closing out the year. So we, China spiked to about 102. This is going to, again, the question is, will we see this get pulled onshore? We did have new facilities turn on that will help pull additional crude through the system. The question is going to be how fast, and is that going to leave some of these barrels on the water a little bit longer, and just in terms of those timing delays. And that's why when we look at Asian floating storage, we're obviously down versus where we closed out 2020. We had that spike into the end of the year, but now we're still, as you can see, we're still at seasonally adjusted all-time highs. And just given the problems we're seeing in Japan, South Korea, that's going to slow down some of this drawdown in terms of floating storage. Obviously, China is still fairly robust. India is fairly robust on the internal side, less on the external side in terms of exporting refined product as China continues to churn out large amount of refined product exports. So that's why when we talk about China, we have to think about both sides of that coin. Yes, they're importing more crude, but they're exporting more product. So there's two sides to that coin. So again, this is going to be something to watch, but just based on what we're seeing on oil in transit, we're thinking that Asian floating storage is going to stay fairly flat over the next couple of weeks as cargoes come off the water, more comes to replace it, keeping us kind of in this steady state. North Sea, again, we finished out flattish on the year. We're obviously below 2017, but we're still elevated in terms of where North Sea is. And now that we have a 3-year record, and if you think about, the last time we produced at this level, they produced at this level was back in May of 17. That's, the question is going to be, will we see some of this North Sea crude move? Will we see more of it, get stuck behind? And that's why right now we think this is going to trend higher, not to 2017 levels, but again, the trend is going to be up in the near term. West Africa is something similar because we're seeing price reductions to try to clear some of this glut. And again, if they can't clear it, then it'll become a certain amount of storage, as we've seen some crude get moved from Singapore that had been sitting there for about a month, getting moved into China. That's going to slow down because it was similar grades to what's coming out of West Africa. That's going to leave more crude on the coast. It's just going to be a matter of kind of the positioning. Again, just given the timing of things, it's something where it's going to be fairly flat as we go through the next 2 to 3 weeks. Middle East is the one that we think is going to see a little bit of an increase. Clearly they're below the average, which is, as we can see from 2016 and 2017. It's going to start to trend up a little bit, but it's still going to kind of stay fairly stable as we do have more Basra crude and more Iraqi crude coming out, which is just going to increase that a bit. Same with the UAE, which is going to be a little precarious, especially as we start to see some of those get elevated into the new year. Europe, something similar. It's going to be, we think it's just going to follow the average at this point. We close out the year flattish, starting out the year down. Again, it's just going to be that timing delay that's going to just follow the average move where we kind of normally see some of these increases. And the reason why we remain concerned is, again, looking at the refined product side. Refined products, even though gasoline exports are still elevated, gas oil exports are still elevated. Gas oil, being on the distillate side, continues to be elevated. We're still seeing builds overall, or at least not the drawdowns that we were expecting. So here you can see, you're looking at gasoline. Gasoline did have that drawdown, but we set a new seasonally adjusted all-time high. Based on where we're seeing, we're going to sit at the top of this cloud, even though we're getting an increase, just because we do have an extension of lockdowns, which is just reverberating throughout all of Europe, which again is just going to put less people behind the wheel, more people at home doing less. Gas oil, again, we closed out pretty flattish. We think it's going to start the year something very similar, but above that average. And the benefit for this is we're seeing less pull through from the Middle East, from Europe from the Middle East, less from the Middle East and Asia into Europe, which again will help keep storage from getting elevated. But again, that's going to put more in Fujairah, in Singapore, on onshore storage, which is just going to limit the amount of flow through. Then when we shift to Singapore, you can see that Singapore, we had a spike from 49 back to 51, and this is just looking at we're closing out the year at the seasonally adjusted highs, which again is just that concern as we head into a new year and that limit as we just have so much product, which this product is again putting pressure on Singapore margins, which if Singapore margins continue to fall, you're not going to increase your oil run throughput. You'll try to sell as much as you can from storage, trying to kind of move these barrels around the world, which when we look at middle distillate, closing out the year at a seasonally adjusted all-time high, this is the concerning side as we continue to see the trend. We're going to kick off the year, at the top of this range, which again, we normally see kind of that drawdown. We're not seeing that. That's going to be, continuing to be the problem as we look abroad. Same thing with light distillates, but when we look at the normal, we at the top of the cloud, we normally kind of see this ramp. It's going to continue to increase as we start off the new year, which is again going to just be a problem as we kind of look at the movements and the supply chain of refined product movements. Independent refiners, they pulled in a little bit more. As we kind of said, it was going to be a kind of flattish into the end of the year. There was about another 2 million that came on shore. Nothing too crazy. Went from about 42.3 to 44.3. Again, now that we have renewed import quotas, renewed export quotas, the import quotas were actually increased. That'll give them some ability, but they're going to have to store more crude, but at the same time, keep it off the water. So it'll help pull down some of the floating storage, increase some of the onshore storage. So these are things that we're going to look at to see what the pricing is. And here, fuel oil, obviously we had a drawdown, but it still remains at that seasonally adjusted high, which is going to be something to watch as we start to see what does demand look like, because local consumer demand remains weak, which is something that we're going to talk about in in the econ show, as we look at ways that the CCP is trying to incentivize local consumption of goods, which obviously filters down into more fuel oil, diesel, gasoline being purchased, and that's something that we're going to talk about, and some of the initiatives that they're trying, not only in the OPEC show, but also in the econ show. So thanks again for watching. I know we covered a lot of stuff. Please, again, like, share, subscribe. If you have any questions, please reach out. We love the back and forth. So I'm Mark Rossano, founder and CEO of C6 Capital Holdings, wishing you a happy new year, and hopefully it's a profitable one. So thanks again for watching.